This is an overview of the long-term debt cycle. It explains how economies can aggregate unsustainable volume of private debt that can result in recessions like the 2008 financial crisis in the United States or the lost decade in Japan in the 1990s. The long-term debt cycle helps to explain how three main forces move an economy forward. The short-term debt cycle creates expansions and contractions primarily through credit within a 5 to 8 year period. It is important to note that central banks do not have direct control over the amount of credit in an economy because anyone can create credit. Since central banks do not have direct control over the amount of credit in the economy, this can lead to the development of debt market events. Central banks can influence credit by increasing or decreasing interest rates. The other main force that moves an economy forward is the long-term debt cycle. It develops when multiple short-term debt cycles end with higher volume of debt successively. Of the three main economic factors, productivity growth is the most important because it does not fluctuate. It increases living standards and allows economies to be self-reliant. Productivity growth is what allows economies to break free from recessionary periods when those happen. Economies tend to accumulate high volume of private debt as part of the business cycle that takes between 5 to 8 years. When interest rates are kept low for too long, high volume of private debt will aggregate at the end of each business cycle. Then when the cycle begins anew, it will start with a higher amount of debt outstanding than the one that ended. This cycle will repeat until the volume of private debt reaches an unsustainable level. At that phase, a large economic contraction will ensue, and it may evolve into a recession. The 2008 financial recession in the United States marked the end of the long-term debt cycle that began in 1985. The cycle burst in 2007 when the central bank began to increase interest rates at the end of the business cycle. In 2007, the volume of private debt was relatively equal to GDP, which made it unsustainable. The bubble burst led to what is now known as the 2008 financial crisis. While many attribute the recession to the mortgage market, that is one of the many scenarios that could have played out when the cost of borrowing is too cheap, and it allures questionable characters to the market wanting to get rich fast. The transition of long-term debt cycles can be described in a 5-phase sequence. The long-term debt cycle takes many years to fully form, which can lead many to be caught off guard when the cycle is near the end. The cycle is at its most critical point at its final phase, which is also when central banks maintain low interest rates to keep the economic expansion ongoing. This makes the volume of debt unsustainable because more questionable borrowers keep borrowing. The majority of the population don't realize that the economy is fragile because these cycles can be generational and everyone wants to take advantage of the low cost of debt while it lasts. Therefore, these events are perceived as unexpected. As previously explained, the latest long-term debt cycle in the United States ended in the 2008 financial crisis that began in 1985 when the central bank started to decrease interest rates after a long period of high inflation from the early 1970s. The decrease in interest rates in the 1980s raised demand for borrowing because the public wanted to take advantage of the cheaper cost of debt. This resulted in Phase 1 of the 5-phase long-term debt cycle. The debt borrowed in Phase 1 was invested productively. It led disposable income to grow at a faster rate than the volume of debt. This expanded the economy, which resulted in better living standards for citizens, who throughout the 1970s experienced a stagnant economic environment. Looking back at the main forces that move an economy forward, we can see that the short-term debt cycles increased the economy's productivity in Phase 1. Phase 1 also provides a good example of how these main forces reinforce one another to expand an economy. At the same time, it shows that if debt volume grows faster than disposable income, the economy could suffer a contraction when the debt is repaid. Note that when central banks do not increase interest rates for a long period of time and interest rates are held close to zero, the rate at which the volume of debt increases will accelerate. Again, interest rates in the United States began to decrease in 1985, and by 2000 the economy experienced an 8-month recession. To help the economy break from the recession, the central bank lowered interest rates further. Then in 2001, the federal funds rate will be lowered again. This time, interest rates would be set below 2%. The objective in lowering interest rates is to maintain the ongoing economic expansion and low unemployment rate. In 2000, the cycle entered Phase 2. In Phase 2, the volume of disposable income and private debt become relatively equal, but the rate at which private debt grows accelerates, and exceeds the rate at which disposable income grows because interest rates are too low. Central banks' efforts to keep the economic expansion ongoing leads central banks to keep interest rates low. This entices illiquid and questionable borrowers to enter the market to take advantage of low interest rates. As a result, economies end up with large number of borrowers that cannot service their debt. To keep the large number of new borrowers from defaulting, central banks keep interest rates low and thus keep the economic expansion ongoing. Given the large number of borrowers that entered the market in Phase 2, financial institutions leverage up to meet borrowing demand. Over time, the volume of private debt becomes unsustainable. When the volume of debt was higher than disposable income and close to GDP, then the cycle entered Phase 3. In Phase 3, the volume of private debt is higher than disposable income and proportionally equal to GDP. The high volume of debt is sustained during Phase 3 because central banks maintain interest rates low, therefore debt is serviceable. Eventually, when central banks begin to increase interest rates at the end of the business cycle, that's when the bubble pops and there's a transition to Phase 4. In Phase 4, the economy goes into a contraction that can evolve into recession. To ease the economic contraction, central banks will then use the tools available to stimulate economic activity. The first policy central banks use is M1, which is the decrease or increase of interest rates. If interest rates are too low prior to the recession, decreasing interest rates will not have the desired effect because interest rates are already at the lowest desired level. At that point, central banks will engage in quantitative easing or M2, where central banks buy private debt in order to allocate funds to the private sector. Buying private debt that has high risk premiums lowers those risk premiums. Quantitative easing lowers risk premiums because central banks buy distressed private debt that no one wants to buy. The money that distressed sellers receive is then used to purchase debt security with high-risk premiums. This leads risk premiums to decrease because there are buyers wanting to purchase those high-risk securities. If the amount of funds allocated to the private sector is sufficient, the recession will be short, and the cycle will move to Phase 5. Assuming that the economic stimulants infused by the central bank had positive effect in Phase 4. Then Phase 5 starts with the volume of private debt decreasing while disposable income begins to rise above the volume of debt. If central banks stimulating economic policies are able to get the economy productivity rate to rise above nominal interest rate, the economy will break free from the recession and will become healthy. If there are no vital institutions at risk during the recession, the economy will break free from the recession if the economy productivity rate rises above the federal fund rate. To summarize, the long-term debt cycle follows the same sequence described but with some slight variation across economies. Phase 1 of the long-term debt cycle usually starts when interest rates are lowered, which leads people to borrow at a faster rate. Borrowing at the beginning of the cycle is beneficial because borrowed funds are invested in investments that raise the economy productivity. Economies enter Phase 2 if interest rates continue to be decreased. The rate at which the volume of debt increases will then accelerate and will overtake the rate of growth of disposable income. In Phase 3, the private sector will accrue too much debt that will not be serviceable if interest rates increase. Phase 4 is triggered when central banks begin to increase interest rates at the end of the business cycle, which leads to a large economic contraction that can turn into recession. Central banks then have to intervene with proper economic policies. If the policies adopted in Phase 4 are effective, the economy productivity rate will rise above nominal interest rates and will break free from the economic contraction to return to good health. That signals the end of Phase 5 and the end of the long-term debt cycle.